Hey everyone! In the previous video, we had talked about financial freedom and we had come to the conclusion that one of the key principles in achieving financial freedom is to grow our surplus capital at a rate of return which is higher than the rate of inflation. Most people do not actively invest or actively analyze financial markets or are even aware of financial markets beyond the term. This is because they have different professions which keeps them busy. So comes the need for a passive mechanism to invest their surplus capital. Now, this passive mechanism needs to be somewhat tried and tested and something which does not require people to learn the mechanics of the financial markets. This instrument that we're talking about, this mechanism, is called ETFs or exchange traded funds. To understand ETFs in more detail, let's check out my presentation. So let's look at ETFs. ETFs are financial instruments which track the price of one or more underlying security, thereby letting you invest in multiple securities by purchasing just one unit of this instrument. Let's break this down. A stock market has multiple securities trading on it. A subset of these securities is used to create an index. You might have heard the term S&P 500, which is nothing but the top 500 companies trading in the United States. Now, top is a qualitative term. It could essentially imply the top 500 companies trading in the US stock exchange. Now, how these are calculated could be a measure of something called market capitalization, which is just another term which essentially tells us how big a company is. You take the stock price of a company, you multiply with all the shares in the market, and you get the market capitalization. Obviously, there are a lot of nuances here. There is no one single method to compute market capitalization, but for our understanding, we can just assume what I mentioned, the stock price multiplied by the shares trading in the market to be the market capitalization. And you've probably recently heard Nvidia crossing $1 trillion of market capitalization. So that's what they meant. So coming back to ETFs, basically, if you'd like to invest in the top 500 or the top 50 companies in the stock market, or you want to invest in a certain subset of companies, then an ETF might be a way through which you can do this. ETFs will track your instrument closely. And the reason I say closely is because there could be a negligible tracking error between how the index is performing versus how the ETF is performing. The tracking error information is mentioned on individual ETFs website and aggregator websites as well. Talking about investing style, the reason why I've mentioned passive index investing is because that's what we are focused on. There are plenty of market participants who use ETFs to trade actively in an intraday time frame or in any other time frame, but that is not what we will focus on. Talking about time frame, I've mentioned generally medium to long, that is 3 to 10 plus years. Time frame in any kind of passive investing would be 3 to 10 plus years, because depending on which market cycle you started investing in, it could take 3 to 10 plus years to actually see any meaningful annualized return. Now, don't take my word for this. Use this screener to take a look at the performance of multiple funds at different time frames to settle on a time frame. Here, you'll be able to look at the performance of various ETFs and be able to shortlist the one that best suits your requirement. Commission-free ETFs. Many Canadian brokers allow you to invest in commission-free ETFs, which basically mean there is no cost of buying them and there might be no cost of selling any unit of these ETFs either. If an ETF you like is a commission-free ETF on both buy and sell side, then it can save you some additional money. The list I checked with one of the brokers is quite extensive and covers many ETFs covering Canadian, US, global, and emerging markets across various sectors. So do check the commission-free ETF list your broker provides. SIP is a systematic investment plan, which is essentially how you implement a dollar cost averaging strategy. So let's say you put aside $500 per month to invest and you do so regardless of anything else. Find dollar cost averaging calculators that let you find returns of a particular ETF. There are various online. These returns would be different than your lump sum investment returns, because in dollar cost averaging, you are investing a specific amount each week or month over a long period of time, whereas in the other, it is assumed that you made the investment at the beginning of the time horizon you're evaluating. So never look at lump sum returns to identify or shortlist ETFs that you want to invest in. Look at SIP or dollar cost averaging returns. Next, we have leveraged ETFs. So just as their name suggests, these are leveraged by a certain multiple, for example, 2x or 3x, and they provide this leverage on both risk and return side. So if an index makes 10%, then in case of a 3x leveraged ETF, the instrument would deliver a 30% return. And the same goes on loss side. So if the index loses 10%, your loss would be 30%. So these are generally a lot more riskier than your average one-to-one leveraged ETFs. Let's look at the average US index ETF return before looking at some actual funds. So here, for the last 10 years, the US markets, we have seen an average annual index return in the range of 12 to 20% annualized, with an expense ratio of about 0.1% charged annually. Now, to understand these numbers, let's look at an absolute return. So if you invest $500 per month over a 10-year period, which equates to about $60,000, and you have a pre-tax CAGR of about 10%, then you essentially have $121,000 towards the end of the 10-year period pre-tax. So you essentially double your money over a 10-year period with a 10% return, and the average annual index return that we have seen in the US markets is in the range of 12 to 20%. So you would have more than doubled your money over the last 10 years had you invested in ETFs on a pre-tax basis. Now looking at some actual commission-free ETFs from a major Canadian broker, we have Vanguard S&P 500, NASDAQ 100, and Invesco Semiconductors. Now, these three are just the ones that I shortlisted. There are hundreds of commission-free ETFs available with the broker that I had researched, and I'm sure they're available with many other brokers as well. So, looking at S&P 500, it has given us about 14% return over the last 10 years on an annualized basis, 11% over a 5-year annualized basis. It is commission-free, yes, and the expense fee is the lowest because it's just tracking S&P 500, so the expense fee is 0.09%. Now, if we look at NASDAQ 100, because we know technology stocks have done well, so we see a higher return over the last 10-year period, a 16.3% return annualized for a 10-year period, 13.6% over a 5-year period annualized, and the expense ratio is a little higher, of course, which is 0.23%. Now, looking at the next one, the reason I've included Invesco Semiconductors here is to make a point that it's not necessary to use ETFs to just track the major indexes. You can use ETFs to invest in sectors as well, sectors you believe might be doing well. So semiconductor as a sector did very well in the last 10 years, and it will probably do very well in the next 10 years as well. So we see a much higher return here, which is a 22% return on a 10-year annualized basis and a 16% return on a 5-year annualized basis. Obviously, the expense fee is higher, which is 0.55%. Now, if you'd like to understand how to compare these various funds with varying returns and expense fee, then wait for part 2 of this video where I talk about how we can compare different funds. I hope you found this video helpful. Thank you for watching.